What is the difference between cash accumulation value in an indexed universal life policy versus cash surrender value? It's very important to understand these differences and when this one comes into play, because it's not about the surrender value if you're wanting to do this for a long-term goal, because this one will end up becoming this one usually within 10 to 15 years. So get ready. I want you to get super clear on the difference between these two. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of people optimize their assets, minimize taxes, and empower their authentic wealth. And my favorite financial vehicle, without question, is a properly structured, maximum funded, indexed universal life insurance contract. And if it's structured correctly and funded properly, it is deemed a laser fund. Laser is an acronym that stands for Liquid Asset Safely Earning Returns. And it's the title of my most recent best-selling book that's been flying off of our warehouse shelves. And if you stay with me, I'll show you how you can claim a free copy of this, okay? So many times when somebody is interested in max funded IUL, because once you begin to study it and understand it, it is a superior capital accumulation tool for all kinds of long-term goals such as retirement, college funding for your kids and grandkids, working capital for business, real estate management, emergency funds, estate planning, and on and on and on. And so it knocks the socks off of putting the same amount of money in traditional IRAs or 401ks once you understand how to structure it correctly. So there's a lot of terminology here that if you're a member of the general public and you're interested in exploring IUL, you want to learn this, because if the agent or advisor that's maybe recommended IUL doesn't even know the definition of these terms, that should be a red flag. And I'll show you how you can find an IUL professional that really knows what they're doing, okay? Now, there is a difference between these two terms, and let me try to simplify it. Cash accumulation value. This is shown on the illustration when an agent is showing you hypothetically what you might expect, usually based upon historical rates of return. But it's not guaranteed, but they're usually showing you an illustration of how this may play out based on historical data. And you'll see 2 different columns on that illustration. You'll see, you actually see 3 columns, basically. You'll see the death benefit, but you'll see the accumulation value, the cash accumulation value, and you'll see a separate column called the cash surrender value. And you'll usually notice that the cash surrender value is less than the cash accumulation value, but this one begins to get closer and closer to equaling this one in the first 5, 10, or 15 years, depending upon what is called the surrender period. So let's say it's 10 years. So let's say that you are paying premiums into an IUL policy, and the objective is to have the best net internal rate of return possible, to have the costs become cheaper as you get older, which is why we use the level death benefit for older people, okay? And then we're wanting to make sure that the actual cost of insurance goes down as you get older, because the net amount at risk is getting less and less and less. Well, when you're funding an IUL policy or any permanent life insurance policy, there are some costs. And so there's an episode where I explain the difference between premiums and costs. When you're paying a premium into an IUL policy, if you're doing what a lot of my clients have done that are in their 50s and 60s and 70s, they're maximum funding it within 5 years most of the time, okay? If they want to reposition $500,000 or $5 million, it doesn't matter, but if they want to put in $500,000, they can't do that in one fell swoop without creating what is called a modified endowment contract, which means if they wanted to access money for tax-free income, it wouldn't be tax-free, okay? Most people want tax-free income. They want every $1 million that accumulates in the IUL policy at the end of the day to generate, 80, 90, 100,000 a year of tax-free income without depleting principal. Well, in order to do that, you've got to structure it so that the costs get cheaper as you get older, and you've got to maximum fund it as soon as the IRS allows. So Many of my clients would put in, let's say, $100,000 a year for 5 years. Now they've maximum funded. They can't put in any more money. They want the least amount of insurance the IRS will let them get away with. For a 60-year-old, that is only about $1 million. You could buy way more life insurance than that for $500,000, but that's not your objective. You want your $500,000 to grow as fast as possible and double to $1 million, and then that $1 million to double to $2 million, and $2 million to double to $4 million, and $4 million to double to $8 million. Yeah, we've had a lot of clients that started out with $500,000. They have $8 million 30 years later because it doubled every 7.5 years. If that's your objective, because we have a client that has $8 million and it generates $600,000 to $800,000 a year of tax-free income without depleting principal. It knocks the socks off of where they used to have their money in IRAs and 401ks in the market. Well, during the early years, if they were putting in $800,000 a year for 5 years. But let's go back and keep this simple. If you're going to put in $100,000 a year the first year, the cash accumulation value might be $90,000 because there's some costs before you get credited interest on that $100,000 you put in there, and so before they've even had a chance to credit the interest linked on an index, you put in $100,000, and the accumulation value, because of the costs associated with it, might only be, let's say, $90,000. Now, you can actually put riders on that I talk about here in this series, where you could have the accumulation value be 100%, or there is no surrender charge. But generally speaking, if you want to have the best net internal rate of return down the road, you don't worry about this one, the cash surrender value. Okay, only if you're worried about, well, if I put in $100,000, I want access to 100% of my cash accumulation value in case of an emergency or whatever. Well, then you pay an extra fee for that waiver or whatever of the cash surrender charge. But most companies, they go, well, we've got to amortize the cost of acquisition because they have to incur costs over and above the actual cost of death benefit, the medical exams and the records and their clerical and their underwriting, and then the compensation to the licensed agent, because you have to go through a licensed agent. They don't work for nothing. And so generally speaking, that is usually assessed or amortized over the first few years of the insurance policy. So if you put in $100,000 and before you've even had any credits, maybe the accumulation value is $90,000, and you're going, oh, wow, I didn't make any money. No, you don't choose this as a short-term, get-rich-quick investment. You choose investments based upon which ones are going to generate the most at the time in life, 5, 10, 15, 20 years down the road, and that you're going to be using the money the most, okay? So you don't get hung up on this because this only comes into play if you bail out and you cancel. I'm getting ahead of myself. Let's go back to this one. Now, the second year, you put in $100,000. Now the accumulation value could very well be $205,000, $210,000, depending upon the credit or whatever. But this surrender value is less than that. So when you put in the first 100, maybe the surrender value is only $60,000. Is that all you're earning interest on? No, the insurance company's crediting you on the accumulation value, not the surrender value. So what does the surrender value mean? It means if you surrender the policy. If you cancel the policy and you surrender it, they're going to say, well, we had to cover our costs. We're in business to cover at least our costs, and they still would probably lose money, but they're saying, if you only put in $100,000 and you cancel after 1 year, you may only get $60,000 back because you're surrendering it early while you weren't even 20% funded in this thing. How can we do this? The cost of acquiring a client and getting it approved and set up is expensive for the financial institution. So when does the cash surrender value come into play? Only if you were to cancel and bail out. You can access up to 94% of the cash surrender value in the event of emergency without the policy lapsing, which would be the smart way to go if you think you want to keep the policy in force, or you want to be grandfathered to keep putting the money in. The only time that this whole surrender value comes into play is if you're going to cancel the policy, or if you're needing to access as much money as possible. This is the number you can access, even though this is the number that you're being credited interest on. So in this example, you're being credited interest on 90 or 100,000. If you canceled it or you needed to go access the money, then they look at the surrender value, and you can cancel and get maybe 60 grand. You could borrow 50, 55,000 out of the policy without causing the policy to lapse. Now, you go in the second year, and all of a sudden you've put in 200,000. Now the accumulation value is probably over 200,000, but the surrender value probably isn't over 200,000 yet. But it's probably surrender value maybe 160 or 170,000. It's actually now the difference between surrender value and cash accumulation value is getting narrower. Well, you'll see this happen to where in 4 years and 1 day, and I say this because if you put in 100 grand the first day of the first year and 100 grand the first day of the second year, basically your fifth premium is paid on the first day of the fifth year, which is 4 years and 1 day into it. In that scenario, many of my clients put in 500,000 and the death benefit was $1 million. And now the net amount at risk is the remaining 500,000. The insurance company is only charging them for that. But now they have 500,000 in there and the costs are going down because they use the level death benefit. Well, that 500,000 many times has grown, but let's just say they put in 500 grand and the surrender value is only 500,000. Well, they're getting credited on the accumulation value, which is going to be probably much greater than 500,000, but they're only charging you for the difference. Now, if you canceled, then you would get the surrender value. But the difference between this and the accumulation value, 5 years into it or 4 years and 1 day into it, now has become very, very narrow. You put in 500,000, the accumulation value might be 550 or 600,000. The surrender value would be maybe 500, 525,000. And you'll say, well, yeah, but I didn't make much money. Well, that only comes into play if you're wanting to access as much money. You can borrow 90, 94%, or if you cancel. If you cancel, which would be dumb in my opinion, then that still comes into play. But the cash surrender value will slowly get narrower and narrower to equal the accumulation value, usually by the 10th year. That's called a 10-year surrender period, or maybe 15 years. Some companies have a 15-year. But even in the 10th year, the cash surrender value is pretty doggone close to the accumulation value. And if you canceled or you need to take out money, it's not going to hurt you that much. But usually there's a period like the 10th year or 15th year where this equals this, and the surrender value now doesn't mean anything, and you'll see this on an illustration. So hopefully this has helped clear up a confusion between the two. This is the one, the accumulation value, the insurance company is crediting you interest on. This is determining the money you're earning is based on this number, which is higher. This one really only comes into play if you cancel or if you are going to go borrow some money out of it. This is the number they use because they've got to leave enough in there to keep the policy in force, so that it doesn't trigger a taxable event or cause the policy to lapse. Does that make sense? If you want to see actual illustrations of this and you're a member of the general public, it's this kind of terminology. When you learn this and you ask agents questions, if they hum and haw and they don't give you an answer like this one, that's a red flag. And so I would recommend that you, if you're checking out an IUL policy, you work with a certified IUL professional, and there's just a handful of them in the United States. But I'll show you how you can find one. But the first thing would be to claim a copy of this book, and you'll see actual examples of this. And you'll see answers to these types of terminology questions in here. This is actually 2 books in one. This side is 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're more of a right brain learner, you flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories. Or you can use your whole brain and read both of these books. This retails on Amazon for $20 plus shipping. If you buy it on Amazon, thank you, but I'll gift you one free, okay? You simply click on the link below, go to laserfund.com, and you contribute a nominal amount toward the shipping and handling. You've got to have some skin in the game. I'll cover the rest of that cost, but I'll pay for the book. I'll fire out a hard copy to you via priority mail. Now, when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's avenues for that. But you can schedule an appointment with a certified IUL professional, what we call a member of the IUL Insiders. But with IUL Insiders, there's only the top 3% that are actually certified. I'm strongly recommending, if you want it done correctly, you not only want to talk to an agent that is an IUL Insider, but somebody who has become certified, because they have to pass a very intensive proficiency exam with 100%. It's not an easy exam. There are many advisors you hear about out there that they wouldn't even score 20% on this exam because they wouldn't even understand 80% of the questions. And so if you're a professional and you want to learn more about how to become an IUL Insider and become certified, go to IULinsiders.com because this is about doing it right for your clients. And if you are a member of the general public, make sure it's absolutely done right for you, so that the difference between these two gets narrower fast, and that they are very small, even the smallest possible from the very first year, but then they equal each other sooner than later.